So today, I want to share a story about a case where we were able to generate an additional $1 million in cash value for a client just through policy design. And when I say an additional $1 million, he was working with someone else. It was a competitive case, looking at the numbers, actually used one of the same companies we did, and we were able to generate a significant greater cash value just through knowledge around policy design. Now, it is somewhat of a unique case. It was a lot of fun, so let's get into it. I'm going to begin the story with how we met. A new agent in our office, it is his first week, it might have been his second week here, is calling people in our system, old leads that we have been following up with for a while. He gets this individual on the phone, 59 at the time. When he started a policy, he was 60, but the agent calls him, and this guy says to the new agent, yeah, I'm interested in whole life. In fact, I've got 2 variable universal life insurance contracts that I am going to 1035 exchange into a whole life insurance product. I'm working with a friend of mine right now who works for Northwestern Mutual. This is what I'm going to do. I've seen your content and I would like to see some options and some more information. You're a brand new agent, new in the business, 2 weeks. You make the phone call. You're doing the stuff that no one else wants to do, calling old leads. You get that. You nervous? I would be. I bombed those when I was new in my career, early on in my career. So the agent here lets me know, we work it together, and we had a lot of fun with this case. And he's competent now. He's been here for, I think he's 2 years now. He's doing quite well. But here's the case specs for this situation. Client has 2 variable universal life insurance contracts with north of $1.2 million in cash value. He's going to 1035 exchange it. We're going to touch on that as far as the pros and cons there, but he's already made his mind up before we spoke with him, and that he's done an analysis with another advisor. Company selection. He wants the best. That's it. Don't show me any small companies. I'm looking at Northwestern Mutual, Mass Mutual. I'll consider New York Life and Guardian as well, but he wants the cream of the crop. He wants assurance that his money will continue to appreciate over time. Does very well, owns a number of dental practices. He wants the good stuff. Like, he's not messing around. Don't try and sell him on something else. He knows what he wants. Product choice. We had a ton of fun with this. I should rephrase. I had done a ton of fun with this because really I got to pull out all the tricks in the playbook, because it was such a unique case with a 1035 exchange of a large dollar amount with $1.2 million plus coming over, plus the amount he wanted to fund, which I'm going to go through exactly what he wanted to do. A lot of fun, and we were able to just maximize the internal rate of return, the performance on this, and it's really how we won the case because he studied the numbers. So a couple things here in the VUL is he wanted out of that. The product had served him well, but he wants out now. Reason why: he's not comfortable with the market and what's going on right now, the increasing costs in the contract with a universal life product. Every year, no matter what happens, your costs go up. He's like, I want out. I'm not comfortable with this anymore. Okay, understands the pros and cons. We look at it, we say, hey, this policy was purchased a while back based on your insurance age at the time. You were young and healthy. He goes, I get it. I see things moving forward. I don't want it. So we assessed it thoroughly. The other agent he was working with did as well. What he wants to do is move it over to a whole life insurance product. He wants the best as far as the company selection, and he wants to see the current values, but also the guarantees. So we must be very transparent. So let's lay out the case specs here as far as what he is doing. So typically when we design policies with the major mutuals, we talk about policy design and what can we do? Money can go toward premium or PUAs, and what's the most aggressive split we can go with? Typically a 1090 split. With a 1035 exchange, there are differences that we need to be aware of. Cannot go with a 1090, not with all companies. So with Guardian you can. So I can have a 1090 split and then have a 1035 exchange on top of it as a huge PUA infusion, and it looks beautiful. With Mass Mutual I can't. All companies have different rules. So here's exactly what he did. He's got a 1035 coming over from those VULs. The net number, when he finally moved forward with the policy, when I say finally, once he was approved, was this But for modeling purposes, we looked at 1.25 million. So that's his 1035 exchange amount. Now from a funding standpoint, he wants to pay in, he had a very specific number that he wanted to allocate toward a policy, and here it is, $250,000 per year. For 7 years. Now that's 7 years he was specific about, and I asked him too, on the funding amount and the funding period, because he had a pretty solid idea of what he wanted to do before we connected. So he said, hey, I'm looking at $250,000 per year that I'd like to pay into the policy for 7 years. So I asked, would you like the ability to pay more than $250K on any given year? No. Okay. 250 is the max. However, do I have to pay that? No, we can design it where we can pay in less. On the 7 years, Mr. Client, would you want to pay longer than that? No, 7 years, that's it. Now we designed it where he can pay beyond that, but 7 years, like that's what he wanted to do. So he's got the $250 per year. So if we go to policy design, normally where would you set that premium? Because money can go toward the premium or the PUA component. Typically that would be what? $25K, you have a term rider attached, but then the rest would go toward PUAs, $225K. He selected as his company Mass Mutual after seeing all the options. We showed a number of options. That's the company he wanted. Now here's why I mentioned this. Mass Mutual, they're a quality company, one of the big four. With their product limitations, they do allow a 1090 split. That is as aggressive as you can design a Mass Mutual policy. However, if you have a 1035 exchange, like we do in this case, you've got a different limit that you have to be aware of. Whatever the total first year payment is, or I should say first year deposit, which includes 1035 exchange proceeds and out-of-pocket payments. So combine those two, what's the total first year payment? $1.5 million. Whatever that total payment is, the base premium cannot exceed more than 5% of that total payment. So 5% of the 1.5, the company is going to look at how much are you paying out of pocket and what is the 1035 exchange. We will combine everything, and that total payment cannot exceed 20 times your minimum premium, or 5%. What's 5% of the 1.5 million? $75,000. Now we mentioned that the net 1035 exchange was about 1.265, so that base was a little bit higher. Here's where I'm going with this, in case you really like understanding the details. Typically, if someone's going to look at a 1090 split policy, we'll look at a number of products, but a traditional product would work. So with Mass or most companies, you'd see that called a paid up at age 100 or age 121. Now, base premium dollars typically do not show up in cash value in the first and second year. With that said, looking at this, you've got a big 1035 exchange, which is a pure PUA deposit. That looks great. But of the 250, to have a $75,000 base premium, I looked at that and said, you know what, that's not that efficient. And it's what he was being shown by the other agent. So, Mass Mutual has a number of products, all companies do. They have a 10-pay product, which I'll add, or I'll state, if it's just a basic funding scenario, it's a decent product, but it's not that great. Like you can do a lot more with the L100, in my opinion, and the same is true of other carriers. I'm only talking about Mass Mutual because that's what he went with. So, that 10-pay not that great from a pure funding standpoint. However, here's the fun part. With a 1035 exchange, I can still set that base premium at $75K with a 10-pay. So that's as low as I can go. A 10-pay product credits approximately 33% of the base premium in cash value in the first year, and it all comes back beginning year 2. So I get more juice. It's also a lower commission. Without a 1035 exchange, it's typically not that attractive. as far as how you can blend a policy. With one, it's unstoppable, especially with one at this size. So looking at all the different options, it's right when a mortality table update came out as well. I'm like, this is the perfect storm with the guarantees and everything. It's like, put the hammer down, let's show them all the good stuff without getting into all of these details that I'm showing. So this is great if you really want to understand the details, which I know I go into a lot. So let's look at the numbers. I want to just add something here. Again, this was a competitive case. So he was being presented options. Option A from another agent here at Northwestern Mutual, quality company, one of the top companies in the industry, great historical performance. We can't offer them because they've got a setup where they only work with agents, not brokers. But with that said, the other Northwestern Mutual agent was showing a Mass Mutual 20-pay product, and then a Northwestern Mutual whole life funded for 7 years. Now, I want to touch on a point about listening here that is critical, and it really helped us win this policy, win this deal, is I asked the client questions on the funding. Do you want to pay more than $250 per year? No. What was the second question I asked him? Do you want to fund longer than 7 years? No. He did not want to. What he was shown by the other agent is as follows. We've got the $200 per year going into the Northwestern Mutual policy, a 1035 exchange of $233,000. Okay. Then he broke it up with the Mass policy, 1035 exchange of $975, base premium of $50,000 and $50K per year. The thing is, this is a flat 20-pay policy. As we scroll down, strong break-even point with that 1035 exchange, but as we scroll down, you're going to see he modeled payments for 20 years. He didn't have to pay 20 years. The agent may have told him that. You can easily flip on a reduced paid up here. But at the same time, are people going to remember what we discuss or remember what they see? What they see. So we have to be transparent when we show different options. This can be challenging sometimes, but here we go. Funding for 20 years. He's like, it's not what I asked for. So what we've got here, combined values. This combines the two policies we looked at, $250 for 7 years, 1035 exchange at the time of $1.208 million. Now, when we connected with him, the numbers he provided were updated. There's a 1035 exchange of $1.25 million. So that gives our illustration, you could argue, hey, that's not fair. That's an advantage where you're showing a larger dollar amount going in. And it is in the first year and really through the first 7 years, about 40 grand more. Let's take a look at something though. So the combined values here, Northwestern and Mass Mutual combo, first year, 1.458 in, almost 1.3 in cash, 1.29. Break-even point between years 5 and 6, mainly because of the Northwestern Mutual policy lagging in upfront cash value. They do have a rider that credits more upfront cash value, but the long-term results do suffer in a case like that. Now, here we go, 1.25 rollover, 250 in, so 1.5, compared to the 1.458, about a $40,000 difference. Yet, you see close to an $80,000 difference in cash value. Greater value there. Break-even point between years 3 and 4. These numbers are all run at ultra preferred with all options. He received the non-smoker rating, and we're going to look at that in the final approval policy that he moved forward with. So here we go, breaking even then. But then here's the difference. Year 7, he wanted to stop. So we have a total of $3 million into the policy with the option we showed him, compared to this guy, after year 7, 2.96, but then he keeps on paying in $50K. So let's compare this. And what do you see? Payments of $50,000 continued for 20 years. And this is where people look at these policies sometimes. And when I talk about the perfect storm with that 10-pay product with a 1035 exchange, that 10-pay is no longer on the shelf, When COVID hit and interest rates went down, MassMutual pulled it, they updated it, and it's not as attractive. It's not what it used to be. The 12 pay is decent. But what do we see here? This option, you stopped payments after 7 years. Your cash value is $8.6 million. This guy, 7.95. Now in the million, I just gave it away. In the beginning of this video, I stated that we generated him an additional $1 million. Is that $1 million bucks? No, but here's what I also want you to look at. Total out-of-pocket payments, $3 million. This guy, $3.6 million. So you paid in 600 grand more in this option, but you have about $650,000 less. So we actually generated more than $1 million bucks there in this case. Now, one thing, we've got illustrations from different companies. That's not really a fair comparison, but even when we looked at the guarantees, it was a drastic difference. Again, what we were able to do with the 10-pay product, with the 1035 exchange, optimizing the limits, a reduced paid up option at year 8, exactly what he wanted to do. With that 7-pay, it was beautiful from a performance standpoint. So before we look at the approval numbers, let me share something here, just a little story. Is before he decided on working with us, I was on vacation in the Outer Banks with my wife Tara, and we were driving back to the house. I think we were shopping for food or something like that, and he calls. And I'm like, hey, he's calling. Can I grab this? Yeah, sure, take it, no problem. So take the call, talk to him when I'm driving. He goes, hey, Steve, thanks for taking my call. Did I catch you at okay time? Yeah. Okay, I got a couple questions I want to ask you. No problem. Keep in mind I'm driving, not in the office, don't have anything I can pull up to reference policy information, anything like that, or numbers or illustrations. He goes, hey, I'm looking at the illustration you sent me, and I've got some questions. Now, his questions were on the actual illustration. He wanted to look at it and really ask questions line by line of the illustration values, what all these columns mean. And I'm in the car. So if you're in the industry, and you have not rehearsed or gone through and cannot explain what these columns mean, I would recommend doing it. Very important. If you are not in the industry and you want to know what these mean, we're going to do that. Now this is based on the current values, the current dividend. We also looked at the guaranteed values, which is what he wanted to see. So we looked at both, which is important. The guarantees broke even between years 7 and 8. Strong long-term performance as well. But line by line, I'm going to go through with what he asked here, and we're going to have a lot of fun. So he said, all right, Steve, I'm looking at this. This is a 10-pay product here. I see that. What's that mean? That means, Mr. Client, you can pay into it for a maximum of 10 years, but you will notice the funding here is for 7 years, just like we discussed. Okay, sounds good. Now, as I look at where my money's going, I've got $250,000 going into the policy. Talk about that 1090 split. As I look at the premium here, before we mentioned that base policy insurance, it's $75,750,000. That's not 10% of 250. What's going on here? Trying to raise the premium there on me? No. So, good question, Mr. Client. So with MassMutual, what you'll find is when we have a 1035 exchange, the insurance company will actually look at your total input. So what you're paying out of pocket, the $250,000, the 1035 exchange, the $2.65 million, add those together, and you'll see this on the annual outlay column, $1,515,000. Okay, I'm with you, Steve. You have a calculator in front of you? Yeah. So if you want to take that number, 151, and multiply it by 0.05. Okay? So MassMutual will allow a policyholder to have a base premium of 5% of whatever the total first year input is, your out-of-pocket payment and 1035 exchange proceeds. That's as low as we can go with the base premium, 5%. This is when we have a 1035 exchange. So we maximized it to the penny, plus 5 cents in that example, based on the 1035 exchange you have coming over. Okay, I think I got that. Makes sense, sounds good. Let's move on. These columns, I get year and age. What's the difference between annual outlay and annual net outlay? They're exactly the same. You can see that in the numbers. Good question, by the way. You will or you may see a difference if we're modeling loans, but in this example, they mean the exact same thing. Okay, sounds good, Steve. What about this column? Keep in mind, I'm in the car driving, so I can't look at this. Annual dividend beginning year. You know, when I calculate these numbers, Steve, I do see I've got a cash value of 1.4 million. Mass Mutual's dividend rate this year is 6.2%. So at a 6.2% dividend rate, like it's a lot more than 25 grand on the $1.4 million. What's going on here? How come the numbers don't add up? Good question. So Mr. Client, with Mass Mutual, and all insurance companies do this, they've got an advertised dividend rate of 6.2%. However, their guaranteed rate is 4%. I recall that. So what that means is they declared a surplus of 2.2% for the year, okay? So anytime you see a dividend column on a life insurance illustration like this guy here, the guaranteed rate is not included in that column. They only include the surplus piece. So in this example, 2.2%. And it's still a gross rate. There's some insurance expenses there. Oh, okay, that makes sense. All right, thanks for answering that. Let's move on. Next column, what does this mean? Basic policy cash value end year. $24,000, $545 in the first year. I paid in $1.5 million total with a 1035 exchange. What's that? Mr. Client, that is a useless column, in my opinion. So what that represents is if you only paid the base premium and that only yielded the guaranteed rate of 4%, that would be the cash value based on that $75,750 base premium payment. Only the guaranteed rate, no term riders, no PUAs, nothing. Okay, let's move on. How about this column? Total cash value end year. Total cash value of additions end year. This is my cash value. Good question. So no, what this represents is money you add into cash value of additions. Think of it as money you add into PUAs, everything above that PUA. So the 175 approximately, and the 1035 exchange, and then also the dividends and interest earned on top of that as time passes. Okay, got it. Total cash value end year, that's your money column, what you have access to anytime. Total paid up additions. So sometimes people get confused with this because we think of paid up additions and think PUA rider. However, paid up additions represents the total paid up additional life insurance added death benefit from PUA payments. Think of it this way. He paid in 75 in base, but just about another 175 in PUAs, plus a 1035 exchange, all of which are PUAs. There's a little bit that goes toward term. But my point is that purchased him paid up additional life insurance benefit of $3.1 million. That increases his whole life death benefit over time. Okay. And then I have my term insurance rider, which decreases each year, which is net costs decrease over time as well. And then the total death benefit. That one's obvious as far as, hey, when you die, money gets paid out. But that's not what he asked. Where do you come up with that number? Like, where's the 6.5 come from? Good question, Mr. Client. So if you want to take your illustration and scroll your eyes down to the bottom right-hand corner, you'll see that term that reads MEC limit. So that MEC limit is the maximum amount of money you can pay into the policy per year. Okay, we can actually set that MEC limit wherever we want, and you'll find that it has a direct relationship to your age and total death benefit on a policy. So we minimized the death benefit as much as we could in order to maximize the cash value. Got it. Okay, this all sounds good. And that's really what helped him move forward with us. And he's a really nice guy. So let's close with the final policy he moved forward with. So we mentioned all of these, the comparison, that was run at Ultra Preferred. But he received a standard non-smoker rating. Now, we should have got preferred, and we can upgrade in the future. We're going to do that. But here's what it looked like. So what do we see here? The 1035 exchange of what? 1.265 million is what was rolled over. The funding of 250 per year, which, by the way, as we track the performance each year, he's made adjustments. So 250, then he paid 200 in 1 year, then he increased it to 300. So he has flexibility in that sense, which is really nice. Total outlay, this allows us to track the break even, which is very important to him. Now, first year, pays in 250, transfers money. He's got 1.4 million in cash value. Total input was 1.515. No matter how you slice it, it's a negative 6.5% hit, which is minimal relative to most whole life insurance policy designs. But still, what's 6.5% of $1.5 million? Crunch the math here. It's about 100 grand. So if I want to really hit on the drawbacks, that's it. If you're focused on the cash value, like that's the drawback right there. And if you look at that and say, I just can't eat that, whether it's 100 grand, $1,000, 10,000, everyone's situation is different, but it's the same because it's our money going into it, that's okay. But we just want to have awareness on that up front, and we always try and point that out. This way there's awareness there on the consumer's end. He said, hey, I'm fine with that. I've got the cash here. This is really meant just to continue to grow over time. Now, the dividend rate was 6.2%. Here's the annual internal rate of return. Year over year, what it produces, strong policy, tops out, and this is a non-smoker, at about 5.4%. What we've got here, the taxable equivalent at 40%, so he's in a high tax bracket. What this means is if we look at year 10, he'll be 70 years old, 5.31% based on this assumption. Taxable equivalent is what? Almost 9%, 8.85%. What that means is at a 40% tax bracket, he would need to earn 8.85%, and then after paying taxes, he would be left over with 5.31%. Now, to do that, can you get 8.85% in a safe area to position money? It's going to be difficult. Maybe you're in real estate, right? Some real estate funds can do that. That can certainly be considered safe. But here, he's got that safe, liquid, and then the big thing there is tax-free area to position his money, which is exactly what he's doing. And the death benefit, while he did not really care about that initially, that's going to have some serious buying power as time passes, because he is going to have an estate tax plan. He already does an estate tax issue, but that's where death benefit proceeds really come into play. He's already been working on generational wealth, as he has policies for his children as well. But overall, this was a ton of fun putting together. Numbers looked great just based on product limitations and us, again, pulling out all the tricks in the playbook. So, hope you enjoyed this video. I hope you've got some value in it. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.